Hi there, welcome to a Kneppy Invest and welcome to my pursuit of high quality companies listed on exchanges around the world. And today I'll be focusing on a company I've never heard of before, Halma. This company is listed on the London Stock Exchange. In fact, it's one of only 20 companies that did satisfy my own personal high quality screener that I call Rule of 10. Yeah, the Rule of 10. And in fact, I'll show you right now. If it comes up, for some reason, Fiscal AI is running really slowly right now. Well, this screener is anyway. Anyway, so it did pop up. In fact, it was the second biggest company that satisfied this particular screener. The biggest company was AstraZeneca. I've already recorded a video on that particular company. So what I'm going to do in this video is I'll have a brief look at what this company does. And the very fact that this is the first time I've looked at this company, I just simply have no idea, except they call the companies our heroes. There you go. A little bit of arrogance there, maybe. Anyway, and then we'll have a look at why this company satisfied my high quality screener, the Rule of 10, and what else we can glean from having a quick look at Halma. Halma, ticker code HLMA on the London Stock Exchange. I think they're also listed elsewhere as well, based off, if you go HLMA, HALMA, yeah, 5 listings. Yeah, it looks like they listed on the OTC in the United States, Germany, and something else, BATS, GXE, whatever that is. Anyway, so that's Halma, and here we go. So I'm just gonna run the screener, London Stock Exchange screener. I've actually just manipulated the numbers to 10%. I just wanted to see what it would be like if I just changed it to 10%. But if you run the screener at 10%, so revenue growth at 10% per year over the last 5 years, return on invested capital, 10% average over the last 5 years, and operating margins, 10% average over the last 5 years, with only companies with a market cap above $100 million. When you run this particular screener, there were about 20 companies that satisfied these filters. And unfortunately, as I mentioned before, Fiscal AI is really slow right now. I'm not sure what's happening. Everything else is running fine, but Fiscal AI is really slow. Maybe there's a lot of people using Fiscal AI today. No idea. Okay. Oh, what's happening there? That's interesting. Let's go back to Halma in Fiscal AI. Oh, actually, I should mention Fiscal AI itself is not running slowly. It's the screener running really slowly. So it's still running. Usually it takes like 1 second. Anyway, so the rest of Fiscal AI is running okay. It's just the screener. Okay, so Halma. Actually, the first thing we have to do is talk about what this company does. Who we are is a good place to start. A global group of life-saving technology companies. So they call themselves heroes. Maybe he's right. Named as one of Britain's most admired companies, a group of nearly 50 companies. So this is a conglomeration of different companies, provide innovative products and services that help solve many of the key problems facing the world today. Well, that doesn't tell me much. Like what sort of problems? They do employ 8,000 people in 20 countries. Our purpose is to grow a safer, cleaner, healthier future for everyone every day. Still no help with what they do. Okay, so our companies. There we go. Maybe we get some more information here. Our companies are small to medium-sized technology businesses who are united by our purpose. They range from high-tech software companies to hardware companies operating in the safety, environmental, and healthcare markets. Many of them are founder-led companies who have chosen to join Halma to help them grow. So it's an interesting business model here. So it's more like, yeah, conglomerate, sort of like Constellation Software, maybe, something like that. And I'm assuming all these different companies have the founder still in charge. So you could also say Halma is just like an investment company. Yeah, maybe. Let's see what Fiscal AI says. Halma, okay, they just say, in fact, the sector here is electronic equipment, instruments, and components. He founded 1894. They have 3 segments: safety, environmental analysis, and medical. Fire detection, specialist fire suppression, elevator security, security sensors, people and vehicle flow technologies, specialized interlocks, etc., etc. So fair bit going on for this company. So if you want to deeper dive, here we go. Let's have a look at some of the names here. Advanced, AMPAC, Apollo, yeah, fire detectors, that's right. fire safety systems, fire, help in emergencies. I'm trying to see if I've ever heard of any of these. I think the answer to that is going to be no. WeTech, testing urine. No, it's not. It's testing critical electrical equipment to keep people safe. Okay, so we've sort of got an idea what this company does. Let's just see how or why this company satisfies my filter. And here they are. Oh, it's been overtaken. Oh, no, it's not. So Halma was the second biggest company that satisfied this particular filter, but I have to run it again because I saw the second biggest company had 9.9% revenue growth. It does not satisfy my filter of 10%. Anyway, so let's go. I'm going to run that again. But let's have a look at Halma's revenue growth. Always start with the revenue growth. Is this company growing their revenue through all their 50 subsidiaries? And the answer to that is yes. In fact, revenue growth has been consistently above 10% per year over the last 3, 5, and 10 years. And it's fairly stable. So you could actually say and argue that the chances this company will grow their revenue over the next 3 years is going to be above 10%. That's a pretty good argument. It's going to be above 10%. Now, the earnings per share growth has been below 10% over the last 5 and 3 years. So a slight red flag there, not a massive red flag, but the company hasn't translated the revenue growth into earnings growth at this point in time. Now, the reason behind that could be quite simple. Now, revenue does not take into account per share. Earnings is per share. So if we had a look at revenue per share growth, maybe it would be below 10%. So the first thing I'd like to look at in those sort of situations, because it seems like with this, if this company has 50 subsidiaries, they do make some acquisitions on occasion. And so I am assuming here that shares on issue have increased. So let's have a look. No, they haven't. They haven't increased at all. So another reason why earnings per share might not be growing as quick a rate as revenue is because of decreasing margins. And we can have a look at that in a second. So let's go back to the overview. And for some reason, my screener is not working at all. It's not working. It's got 27 results, but it's keeping companies. You can see I've changed that to 10 each, but I've got a few companies here. Like, for instance, Admiral Group has return invested capital 5-year average at 9.2%. So something is wrong with Fiscal AI Screener. It's actually not working right now. Perfectly working anyway. But it does not matter. Halma is there. Halma is there. So let's go back to Halma. Now, this company has a market cap of 12.12 billion euro, not euros, pounds. It's English, pounds, not euros. So that's another thing I should mention. Okay, so we want to have a look at margins. Are margins dropping? So that could be a little bit of a negative sign. Next thing I'd like to look at is gross and operating margins. Gross margins are 50.7%, operating margins are 19.2%. This is just a 1-year sample. It's not a 5-year average. We can have a look at that in a second. Return invested capital 12.4% and return on equity 16.8%, a 5-year average. That's pretty good. What else can we look at here? A little bit of a dividend, not much. A payout ratio of 29.5%, dividend yield 0.7%. I do like that because if the company is generating cash flow, I'd like to see the company put that cash flow back into acquiring maybe new companies. Yeah, new companies, more growth in the future. P ratio 41.4 and debt, not a lot of debt. So debt to equity 0.4 and net debt 535 million pounds, which is not much compared to the markup of the company. Okay. So, first thing, you could also have a look at the bulls and bears, say, apparently the CEO retired after 18 years. Oh, that does lead to a little bit of uncertainty. The other thing about this sort of company is it'd probably be very beneficial if you know a lot of the particulars around the 50 individual companies. That would be really important if you're more interested in this company. So, and that would be a lot of work. Okay, let's go back to Halma. And what I want to do now is just have a look at revenue, income, gross profit margins, and operating margins. We'll look at this one in a turn. We'll get rid of operating margins and just focus on revenue and profit. Now, the revenue is beautiful. Revenue growth is beautiful. The only little bit of a dip in revenue was in 2021, but over time, revenue is growing. In fact, revenue has tripled in the past 10 years. Profit has not tripled, so a little bit lower increase in profit. Well, we already knew that, but profit has increased from 108 million, 0.8 million to 296.4 million. And yeah, it's still growing, but not as quick as revenue. So that sort of means this company has seen a bit of a dip in margin. So let's just confirm that by looking at gross profit margins. And there is a bit of a dip here. In fact, there's a big dip in 2019. So it went from about 53% down to about 50%. Now, the last year margins were the highest gross profit margins this company has seen in 6 or 7 years. So that could be a good sign. And the other thing I want to look at is operating margins, and operating margins have been growing. There you go. So gross profit margins have been dropping, operating margins have been growing over the last few years. But it's a little bit deceptive, this, because the range is not that great. So if you go back 10 years ago, operating margins were 18.3%, now 19.2%. So it looks a little bit more impressive than it actually is, but at least they're not dropping. So I thought maybe operating margins were dropping. There could be other reasons why profit has not been increasing at a greater rate than revenue, but I don't see any sort of consistent write-downs or anything like that. Yeah. Anyway, so next thing I want to look at is we'll have a look at return on equity and return on invested capital. I'm pretty confident that both of these particular metrics are going to be above 10% consistently year after year, but I just want to confirm that. We can look at it one at a time, and yes, this is return on invested capital, and it's been above 10% consistently every single year. It's been as high as 14%, so as low as 12%. So between 12 and 14%. So that's fairly consistent, isn't it? That's a good sign. And the other one is return on equity. Let's hope this is consistent as well. A little bit of a drop in the last few years, but nothing too concerned because it was a one-year drop and going back up. And again, above 10%. In fact, above 10% consistently every single year. Now onto some valuation metrics before we have a look at the chart. So we have a look at P/E ratio, free cash flow yield, EV to free cash flow, EV to EBIT. And we'll have a look at some of these individually just to see if there's any big spikes. So this is the P/E ratio of the company going back 10 years. No big spikes here. So this is a good, you could use this as a good indication whether the company could be cheap or expensive right now. P/E ratio at 41 is not overly expensive or not overly cheap. In fact, the P/E ratio on occasion in the last 10 years has fallen below 30. And when it falls below 30, it looks like that could be great buying for this company. But at this point in time, it's 41. Highest P/E ratio is about 55. That was back in late 2020, early 2021. And I'd say a lot of companies back in that period were probably expensive. So I would say just based off this, neither cheap nor expensive. Now, just the P/E ratio, we could have a look at free cash flow yield. Now, I did not have a look at free cash flow, and it does look like the free cash flow yield at 3.67% is towards the top end. So based off cash flow, this company could be looking a little bit cheap. It could be as low as under 2% back in 2021. So this little metric or valuation metric might be suggesting, hey, there could be some value in Halma. The next one is EV to free cash flow. I would assume, yeah, this one, yeah, when I see spikes like this, I sort of ignore it. And the other one is EV to EBIT. So just based off this, so this is not a spike. This is like it was gradually growing up in 2021, got to 45 and then fell, got as low as about 20 and now has been rising. So I'm expecting to see a bit of an uptrend in the chart over the past, maybe 6 to 9 months. Currently, EV/EBIT's at 29.64. So again, not overly expensive, but not cheap. If I saw the EV to EBIT of this company getting to maybe, it looks like the lows have been about 22. Yeah, so 22 is a low. That would be nice buying for this company if you just had a look at that EV to EBIT metric. Okay, so let's have a look at the chart for Halma. So this is the weekly chart. Yeah, in fact, the weekly chart does show a high-quality company. In fact, yeah, they listed in 1995. And there was a great period between 2010 and 2020 when the share price just went bonkers. In fact, it looks like almost like a 10-bagger during that period. Share price pulled back during the rise in interest rates. And that could be because of the companies, this company, or their subsidiaries. 50 subsidiaries. If some of these companies are growing quickly, a rising interest rate environment will sort of lower the valuation of those companies. So I can definitely understand why the share price might have decreased for Halma during that period. And that would have been prime buying opportunity for this company. And since then, the share price has moved back into uptrend. Share price has reached an all-time high. It bounced off the 200 moving average back in April, and that is a nice little signal there. And yeah, the share price has increased. In fact, the chart does look good. Daily chart looks pretty good as well. And the share price is currently in an uptrend. Nice uptrend with a little bit of weakness during April. That's about it. Okay, that's all I have for Halma. Very first look of this company. I'll call it an investing company. I don't know, conglomerate investing company. Anyway, if you have any questions, any thoughts about Halma, I'd love to hear them. So leave them in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.